curious to know, when you look at the retail sales story in this country right now, what do you see?
Right. So the retail sales data this morning was actually kind of exactly as we were anticipating, because we ahead of time actually do get some amount of information from tracking of our own credit card spending data here at RBC. And what that data really tells us essentially was that there was some amount, like you said, of nudging spending, holiday shopping really towards, later, maybe in December this year, because of what was announced on November 21st. And that was kind of the day that we actually did see, very interestingly, spending started to tail off a little bit more. So kind of in line with the retail sales this morning, but then the bounce back was pretty substantial actually in December, also in line with our card tracking data. So it kind of just tells us, consumers were just waiting for the tax holiday, as opposed to, just softening spending trends that's persisting.
Okay, and then if I had to just get a broader picture from your vantage point of what Canada's economy looks like right now, because obviously there's been a lot of worry out there, especially this looming tariff threat. What would you say? Yeah. What's the scorecard, would you say, on Canada for now?
Honestly, I think it's sort of, the cautious optimism is sort of the way that I will characterize. At least that was my read from business sentiment, according to the businesses that participated in the Bank of Canada Q4 BoC survey, Business Outlook survey. So what I was reading essentially was Canadian businesses, as of the fourth quarter of last year, they were feeling better about the domestic backdrop, right? As rates cuts from the Bank of Canada, larger ones towards the end of last year as well, continue to trickle through to support economic activity, making it easier for Canadian households to pay their mortgages and other spending, for Canadian businesses to borrow and to invest. So those sort of easing on monetary policy is going to continue, and that's what we're kind of expecting the Bank of Canada will do next week as well, to continue to cut rates to support the economy. So as that starts to happen a bit more in 2025, the domestic backdrop is really improving, and that's really reflected in sort of the sentiment in the BoC survey. A lot of businesses were pretty optimistic about sort of demand backdrop, even though they were pretty weak still as of the fourth quarter of last year. But the outlook is brighter. But then, like you said, obviously there are other things that are balancing that off. The top concern these days remains sort of the tariff uncertainties. It did seem like we got a very brief reprieve on the first day of Trump's inauguration, but there's obviously more threats that are floating around. And I think it's a huge amount of uncertainties as to what shape or form these tariffs can really take on. But it's probably already, to a certain degree, dampening business investment decisions, just because of, again, the uncertainties that's associated. So some indicators that we point to include, imports of machinery equipment is very weak still. So the latest data that we get they're still around 15% actually from the peak level back in 2023.
And so against that backdrop, which was very helpful, Claire, what do you think the interest rate road looks like? I mentioned we've got that interest rate decision coming up in less than a week's time, but obviously a lot of people are trying to figure out where interest rates are, call it 6 months, a year from now, too.
Right. Yeah. So our forecast is very plain and simple. We kind of expect the Bank of Canada will keep supporting the economy essentially by cutting interest rates very steadily at a 25 basis point per rate cut per meeting pace for the first 5 meetings of this year. So the 5th meeting will be the end of July, actually. So by the end of July, that's when we will see the overnight rate drop all the way down to 2%. And 2% is basically a touch below sort of the Bank of Canada's estimate of what is called a neutral range of interest rate. So it would be technically in the stimulative territory, meaning that at that level, interest rates are supposed to be stimulating economic activities. And that's just what we think, the current backdrop is needing rates to go that low essentially for, again, the demand backdrop to pick up persistently in 2025 and labor market backdrop to pick up sustainably this year as well.
Now, when it comes to the Canadian dollar, which a lot of people have noticed the weakness in our loonie against the greenback, how does that factor into the Bank of Canada's thinking in your estimation?
Right. So at this stage, it doesn't. That's kind of what we're thinking, because a lot of sort of the weakening within the Canadian dollar actually to date is kind of in line with the broader weaker economic fundamentals here in Canada. Part of it, of course, is US dollar strength. So that's the story as well. But it is really this divergence, right? You have the Canadian economy increasingly underperforming pretty much all other advanced economies at this stage, versus the US economy, on the other hand, is outperforming with their, again, they're supposed to have their fourth quarter GDP data next week as well, which is, again, looking pretty strong, pretty solid, with very solid consumer fundamentals. So it's a very different backdrop that's leading to this rate divergence, right? We're expecting essentially the overnight rate in Canada will drop to 2%, versus the Fed next week probably won't cut, right? So that's our outlook for the Fed, which is that they're gonna pause at this point and keep the funds range right at 4 to 4.25, and that's going to be a pretty substantial and growing rate gap between the two central banks, and that's going to continue to put pressure on the Canadian dollar as it did in the past.
Claire, always great to get your insight and analysis. Thanks very much for providing it with us today.